Welcome back to Finance Friday. Last week I talked about abundance and scarcity in the mindset and really how that plays into a competitive or a collaborative environment. And this week at a chamber event here in Fargo, Marissa Orr also talked about the competitive versus collaborative environment and how that influences our ability to be successful in those various forms and those various environments. So make sure you check out last week's video about that. It's called Abundance, but we get to the point of abundance mindset is really more of a collaborative environment, encourages a collaborative environment, whereas scarcity mindset really encourages more of that competitive environment where there's a winner and loser. Collaborative is more there can be win-wins, and how do we identify those opportunities and how can that really build the morale in an environment, because not everybody is wired to be competitive and not everybody really enjoys that environment as well. So we want to be aware of those differences in our people that we lead. So today I want to talk about this concept of plateau. And when I started to do research on this and thinking about what does the plateau mean to the business owner or the business leader in their department, and often what I was getting in that word itself is this kind of stagnant, let's say sales, for instance. So in a stagnant sales situation, and that was the number one type of things, is how to overcome your plateau and in those different things. But the idea behind it was you do business, you work hard, so this is advancement, and then you just sustain or have success, and then you do advancement again, success, advancement again, success. And that's a little bit different concept than what I wanted to talk about today. I wanted to talk about two different things with this. One is kind of the plateau and the fact of fixed costs. So bringing you back to your accounting 101 for any of you business students, and really understanding your fixed costs and your variable costs so you kind of know your break even so that you can be successful. I've had a lot of people talk about growing being a big thing, but growing just to grow is not a good thing. Growing strategically to build more wealth or have operations be more successful makes sense, but sometimes you get these plateaus, if you will, of growth that can help and or hurt your growth. So I want people to be aware of this, that growing just for growth's sake might actually put you in a bad spot on the spectrum where you're not actually being as profitable. Does that make sense? So we're gonna go through a little bit of a demonstration on that. We're gonna talk about the sweet spot, talking about how sometimes staying small is not a bad thing, and then the areas of margin that you make the biggest bang for your buck. So this is the concepts that we'll cover today in what I call the plateau, but it's more of a fixed cost, variable costs. How do we get those things done? Okay, so if you aren't familiar with fixed costs and variable costs from cost accounting, if you took it, so your fixed costs are those things that don't change or change incrementally. So fixed costs could be your rent or your mortgage, maybe some management salaries are fixed. Your utilities, all the things go with renting space. You have insurance. You have, we'll just call it office supplies. This might be management and admin. Or I wrote fixed here. This is supposed to be wages. Salaries, wages. So these are all kind of like your support things. So when we think of in some of the bigger companies here in town, they call them the field service center, which is basically a corporate office. those are all fixed. But this can also be, if you have a small organization, you also have fixed costs. You also probably have space and have management salaries that aren't direct influencing the thing you're selling. You have insurance, hopefully. You have office supplies. There's other professional fees like those pesky accountants and tax preparers, as we're in the heart of tax season and audit season. So you professional fees, those are fixed. So if I want to do business in a certain sector, I have to have an audit. I have to do my tax return, all of those things. That we can just throw taxes as a fixed cost too. They are a little bit variable because they do fluctuate with your businesses, but it could, so I'll take that off there because it is more variable than anything. So fixed costs, the concept of fixed costs is that they're fixed. Well, that's true, but also not true. So this is more of the step kind of thing. So where you have fixed costs here, and this is kind of the capacity. If you did take cost accounting in college or in high school, this is the capacity kind of mindset. So say at this level here, I can build 1,000 widgets. And then to get to 2,000 widgets, I have to increase my space. That's enough. I have to increase my space. I have to get another shift manager. Or somebody to be in that space supervising. My utilities go up. Utilities. All of those things, insurance, all of these things are going to increase when I go from this point to this point. So I've increased my capacity so that I can increase my sales, but I also increase my fixed costs significantly. Like if you are growing in a business, say that you're right here. These are the sweet spots right here, the down spots. We'll put X's for the sweet spot. X marks the spot. These spots are going to be the lowest margin spots. The top of the stairs, so the tip of the stairs is going to be your lowest margin spot. And why that is your lowest net income area is because you just increased your capacity, but you're not accelerating on it. So you just increased all of these things, all of these fixed costs went up, but you're not here yet. So you're only selling 2,001 units and so on and so forth until you get to the 2,999 where you're maxing out your capacity in space, your capacity in your machinery, your capacity in your human resources. What is your human capacity at that level? This is the sweet spot right here before you have to make the next investment to get to the next level. Now, when you're going through growth and rapid growth, sometimes this becomes less strategic. So you're like, I have to increase capacity. I have to make the next hires. I have to increase my square footage at my office or warehouse, or I have to buy more machines to be able to do the work. Now, if you do that, that's great, and I want you to be successful. I want you to grow, but you have to be very intentional, knowing that you can at least break this point, but you really want to be as close to capacity as possible to get the most financial gain from your situation. So that's the other thing. So how does this make sense in manufacturing, right? So I can make 1,000 widgets here before investing in more equipment, space, all of those things. And then here, if I invest in that, then I can make 2,000. But if I make 2,001, that doesn't quite work. I have to make 2,999 to feel great, really living on the edge of capacity. Here's another analogy that works pretty well in this capacity mindset when it comes to fixed costs, because fixed costs aren't fixed. They're fixed for a period. The other thing is in real estate. So everybody thinks real estate's sexy. It is. It is for various reasons, but I want to explain this to you too. Say I buy an acre lot. This will make it really fairly easy to understand. And here's a main road. Let's call it Main Avenue. So on this main road, you're going to build your office building here. Actually, we'll build it back a little bit because you want parking up front probably, depending on what kind of building it is. So we're going to build a building here, and then you have parking here. And you don't know what you're going to do with this space. Let's say there's a road here too. It's much less used, but much more visible. So if you're going to buy this half-acre lot, but only build on half of it, and code will tell you what you can and cannot build on, you're missing opportunity on all of this land. Missed opportunity. Or if you're okay with that, which you can be totally fine, future opportunity, you just have holding costs. So your holding costs are more expensive than they would be if you only bought a quarter acre, or if you maximize this and maybe built a bigger building and rented out bay 1 to you utilize 3. Make sense? So this is underutilized space, and that happens in all sorts of businesses. Whether you're in real estate, whether you're in construction and your equipment is sitting idle, whether you are in the transportation industry and your equipment's sitting idle, it happens all over. That you're not meeting your capacity. So growing just to grow, let's go through this again, the steps. So this is fixed costs. Where do you want to be? Right here. Right? So when you are here, when you're here and you want to go to here, yeah, you got to go through this. But let's try and shorten that time, okay? So if I'm here, let's use the analogy that we were, 1,000. So I can produce 1,000 here at this fixed cost number. I want to get to 2,000 units. So I know I have to invest in human capital. I have to invest in space. I probably have to invest in equipment or whatever it is that I'm selling. But I want to get there as quickly as possible, because if I'm only selling 2001, I just beat down my bottom line for very little gain, because then you just have your marginal, your variable cost gain. So very important that if you make this investment, you're shooting for this. You're not shooting for anywhere else along that line. You want to get there, okay? So we want to be at 2,999, which is capacity, right? We want to be at capacity. That's our best bet financially. So the tough part is, how do I stay at capacity? And that comes into leadership. That comes into knowing your clients, or knowing your industry very well to be right at that sweet spot. It comes with experience. So trying to be at that sweet spot in those fixed costs is very important. So variable costs, just so that we cover that. Variable costs are your cost of goods sold, which includes labor, material, other overhead. So like if you are selling product and you mail it, so this could be stamps, right? This is a direct cost of goods sold. I would not have this cost if I didn't sell something, but it may seem minute, but if you're mailing stuff all over the United States, it matters. What are some other direct costs? So if you have like third party, we'll just call them subcontractors, because I'm come from the construction world, so that makes sense to me. Those are your cost of goods sold. Those are your variable costs. So variable costs increase as sales increase. And they do it at the same rate. They're incremental. Where fixed has the step ladder thing, these are incremental, always. So if we draw those two, we'll see how good I am at drawing, which is probably not very hopeful. Okay, so we have our fixed cost, and then our variable costs. So let's see if I can, what do I want to hit, this or that? Actually, it's probably not a good analogy, but anyway. So our fixed costs, they behave differently, and that's why it's important to know the difference. So fixed costs are, what word do I want to use? I want to use stagnant, but I don't want to spell that. Are fixed, are the same in certain levels of volume. Variable costs change directly, we'll just say directly, with volume. So I've seen it so many times that people will be here, they'll be here, and they'll be excited to grow, so they'll make a hire, so then you hire, or you increase your space, hoping to get there, but what happens is you just go here. So if you're higher and your new space and all those things don't really allow you to grow your capacity so that you can be here at $299.9, then all you did is increase your overhead. All you did is increase your fixed costs. So you need to be very intentional and strategic about when that is. Even to the point where I was already overproducing, let's say 220, I was 5% over my production, or this would be 5%. I was 5% over, or that'd be 10%, whatever. Anyway, I was over my production, and that's when I choose to add the overhead. That's when I choose, is because I can sustain it, or I know that I have this big deal coming down. So when I wanted to talk about plateaus, it was more about that getting over that fixed cost plateau and being very strategic that you're not just adding overhead to add overhead. And when you think of like overhead, it's not just the accounting team, so I'm an accountant, or the marketing person, or all those things, because those can all support and get you to the next level too, but it's also all the other things. It's all the other things. So you want to make sure that you're being super strategic about your volume numbers and knowing those things. So I had a conversation today that was very interesting about about what numbers to look at. Okay, so you have your traditional P&L, right? So we have sales, and I'm just gonna throw numbers at the board, and then we have cost of goods sold, let's say of 300,000. So we have a gross margin of 200,000, and then we have overhead, or our fixed costs. I'll put that on here so that we're consistent in our language, of 100,000, and so we have 100,000 in profit. Net income / profit. That's why this is called a P&L, profit and loss. In the formal accounting world, it's called your income statement. Oops, net income. Income statement. Now the key to understanding financials, which I don't know that a lot of people besides accountants really understand financials, but an income statement or P&L is over a, okay, I use Trigby's pants here to clean my board, over a period of time. So a lot of times at the top of the financial statements, you'll see Q1 or the dates, or year to date. And a lot of people are calendar year end, so a lot of people are finishing up their 12/31s, which is 12 full months of financials. So the concept that I wanted to talk about, because if you don't understand this, you're not going to understand your fixed costs, which understand your plateaus. So is this good? Is this a good financial statement? Think about that. If you're saying yes, why are you saying yes? if you're saying no, or there's not enough information, what more information do you need? What if I told you this was Amazon? This was Amazon's 2019. What would you think then? They're going out of business. Amazon does billions of dollars in sales. If this was their P&L, they're going out of business. Because their CEO makes a crap ton more than that. So they are going out of business if this is theirs, right? So how do you make this information valuable? Well, first off, you have to put a time period on it. So you almost always see that if you have an accountant preparing it. Actually, so one thing that I do see often is people will just print it. So it'll be like let's even choose an odder date. The 13th of February, 2019. Okay, well, let's not do that. Because when did I bill? When did my customers bill me? And this isn't going to be a good thing. So having it at the end of dates is important. So if you are just going in and printing your P&L on a random day, just be cautious of that I maybe bill on the 1st and then get all my costs come in throughout the month, or vice versa. Maybe my costs are coming in throughout the month and then I bill on the last day of the month. That's going to throw that off if you use just random dates. So you got to use a date. The other thing that's super important is a comparable. So let's just say this is whatever in 2019. Okay. Compare it to last year. Did I do better in revenue than I did last year? Did I maintain a 40% margin? Did I have a 40% margin over last year? If this is numbers higher than last year, then I'm doing better. I'm controlling my costs better. Did I drop 10 or 20% to the bottom line? This has got to be service-based because that's pretty good. Did I drop 20% to the bottom line last year? If last year I dropped 50%, what the heck am I doing? What am I spending this money on? Am I in the wrong spot? Am I in between the plateaus? So if I spent in 2019 $100,000 in fixed costs, and we'll say this is our fixed costs, and say our volume of the 500,000. No, we'll just call it 500,000 in dollars rather than convert it to units. Say in 2018, my volume was 450 and my fixed costs were 50,000. Was that additional 50,000 of overhead worth it? If all the other numbers are the same, my bottom line's going to be the same, right? But I increase my revenue. Wouldn't you hope that my net income increases? And if I invested $50,000 in overhead, say I added a salary, and you know, there's work-life balance too. So maybe I added a salary and now I am not going crazy. There's a ton to that too. But if I added a salary in hopes to do more, to be more, but all I did is break even on that salary, then I might not be in the right spot in the steps. So here my cost was $100,000. Oops, I'm sorry. Okay, so I was at 50,000 of overhead fixed costs and 450 of revenue. Now I had to invest another 50,000, so now I'm at 100,000 of overhead costs, but I only got to 500. So I'm right here. We'll do an O since it's so scary to be there versus here. I doubled my overhead. Shouldn't I double my revenue? Not always. So the sweet spot over here is 900,000, not the 500 that I got to. So being very intentional about your numbers and about how adding overhead gets you to the next level maybe, but where along that plateau are you playing the game? So be very conscious of your fixed costs and then your variable costs and how much you have to do to move along to the next sweet spot. Make sense? All right. So that's why we talk about staying small. And when I say small, small is relevant. To Amazon, Shields is small, right? So, and that's maybe a little bit overboard, but you get my point. So let's pick a boutique that's just blowing it up. So the Nines in Detroit Lake. So I think they did, or it was published, about $4 million in sales in a year, which is freaking awesome for their group and that they're doing that and they are just killing it, because on my Instagram I'm like, yep, I want that, I want that. But then compare them to Shields, who's doing, let's say, $100 million of sales a year. It's all relevant. Doesn't mean that they're necessarily doing a better job or taking more home, or in Shields' case, returning more back to their employees because they're employee owned. So knowing where that sweet spot is in your business is very important. So first off, you have to have good numbers to rely on, because if you have bad data and you really can't find your sweet spot, you also have to be very strategic about when you invest in people, when you invest in space, those fixed costs, so that if you're growing a large amount by adding those and not just incrementally. Or maybe the increments are strategic and maybe it's a 5-year plan. That's totally fine, but just so it's planned, because if it's not planned, what's going to happen is you invested that $50,000 hoping to get here. If you're not thinking about it, you're just going to sit here and you're going to be no better off. You're going to spend more money and not do any more with it. Now, if it's a hire, you're changing somebody's life, so you got that going for you. But just wanted to make you guys aware of this, because I see it happening quite a bit when people want to grow, just to grow, but really being strategic about, am I getting here fast enough? It could be 1 year, it could be 5 year. Every business is different, but am I getting there? Am I making progress to it? I don't want to sit here. This is the bad spot. This is the unhappy phase where I invested the money and I just can't get it going. So make sure you're strategic in where your investments are, and we'll see you next week for Finance Friday.